How's it going, guys? It's In the Money. I'm going to talk about the inverted yield curve today, which has preceded every recession since basically, I think, the 1940s. And I made this video already, and then I went and looked at Marco at Whiteboard Finance's channel, and he made a video that started off pretty much exactly the same. So I guess great minds think alike. The last thing I want to do is rip off Marco. He's a great guy, great quality guy with quality content. But I still have a different take on the yield curve inversions than he does. So I want to talk about that. What is the yield curve? Just really quick. The yield curve is how much maturities, treasury maturities are paying at different maturity dates. So near-term maturities are going to be paying lower yields than later term maturities, just because the later term maturities carry higher risk. I mean, if you think about it, if you go far out in the future, like, 300 billion years, maybe the stars are so far apart, there's no light anymore, the sun is burnt out, and there's no Federal Reserve. Then there's risk, right? So take that one step back. Further out in the future, it's possible that the U.S. can default on its debt, and you don't know if that's the case or not, and so you want to be compensated financially for that. So usually you're going to have a higher yield at later maturities. Yield curve inversion flips, or a yield curve inversion is when it flips, where shorter term maturities are paying higher than longer term maturities, to reflect the fact that we are more concerned about what is happening right now, and we want to be compensated for what is happening right now than later. We're not so concerned about later, which has, like I said, I think preceded every recession since the 1940s, I believe. Or maybe, Marco says 60s, but I've read 40s, one of the two. The data really I'm looking at really only goes back to the late 70s. But let's talk about the data really quick, because it's going to be important to the point I make that is going to be so salient and delicious here in just a minute. So this is the Federal Reserve Economic Data website, and this shows the 2-year and the 10-year. You could look at all the maturities across the curve, or you could take two, which is the 2-year, and the 10-year, which is kind of the go-to to look at when you're talking about the yield curve inverting. Because that's all you need. Why would you compare a bunch? You could. I'm sure there's data out there for that, but 2 and 10 years is just fine. When it goes below this black line, that is 0. 0 basically indicates that they're paying the same maturity. If it inverts, goes below 0, that means the 2-year is paying more than the 10-year. So that'd be an inverted yield curve. And then these gray sections are recessions and how long they lasted, right? Sorry, so far I'm still stripping right off of Marco's video, but I will diverge here in just a second. So it inverts in 1978, September of 1978, and then we have our recession in February of 1980. So that's about 2 years, right? If I'm doing that right. This is too messy to even look at. Okay, it inverts about January 1989, and we have our recession at June of 1990. What was that? January 1989, June 1990, so a year and a half or so. It inverts at February 2000, and then dot-com bubble is 2001, March 2001, so about another year and a half. Here it inverts at January 2006, and then we have a recession in 2008, another couple of years. Flashed briefly negative, at least at some maturities, in August of 2019. Here it says 0, but I know it went negative. And then we have the shortest recession ever a few months later. It lasted a couple months, and then a huge equity boom, and now we're dealing with that equity bust, right? And now it's very, very negative. 2 things I want to address is, one, why don't people talk about the fact that recessions tend to come after the yields go positive again, right? So in this case, that's not true, but it almost is. The yield curve goes positive before the recession. Same with this case. So the 70s and 80s were a little bit different. Maybe similar to our time, but it goes positive in the 1990s before we hit a recession. It goes positive in 2000 before we hit a recession. It goes positive in 2006 before we hit a recession. So that gives a lot of time. It goes positive in 2019 before we hit a very tiny recession. And now we're very negative. And it makes me wonder if we go positive before we hit a recession again. But I also want to talk about how this hasn't been 100% accurate for as long as Treasury bonds have been around. It's only been accurate for the past, 60 years, which is what, I don't know, maybe the 8 recessions or so. maybe 10. I don't know. I'd have to look into that. Which does show that there is some correlation, but you also have to think about the disparity between when it inverts and when the recession actually happens is so different between different yield curve inversions that you wouldn't know when the next recession is going to happen, even though the yield curve inverted. If it inverted and then 6 months later you had a recession, you would know exactly what to do. You would sell and let the equities panic as bad economic data came and bitch slapped you in the face. And then you'd buy back at the bottom and it'd be great. You make tons of money. But that's not the case here. We don't know exactly when the recession follows. And so what that means for your portfolio is you have to have a robust portfolio, a consistent portfolio. And if you trade, you should be trading with a small portion of your portfolio. There's so many people on like Reddit and stuff who go like, why don't you do this strategy? Like, it's been working great for me. And I'm like, I've literally asked them, I'm like, how long you been doing it? They're like, well, 2 months, but it's like, okay, then you can't make money over the long term. And that's the vast majority of people. So don't fool yourself, fool. Your portfolio has to be robust. Your trading strategy has to be robust as you head into these uncertain times. And I don't need to know that the yield curve is inverted to know that a recession is likely. It's literally everything. The only thing everybody can talk about is an impending recession and whether or not we're going to have a soft landing. I see a soft landing as unlikely as transitory inflation was. And so while we have this bull run going now, it won't last forever. Right now, bad economic news is good because it means that rate hikes will slow and stop, and we just want that to stop. But then, like I said, bad economic data, I can't get rid of that noise in my throat, will come in and it'll smack you around like a little baby, and then we'll hate that, and equities will sell off. That's what I think. So do I need to see an inverted yield curve? No. But is it a useful tool? Also, no. Usually there's a lot more information already being provided before the yield curve even starts inverting that hints at a recession. I would like, if I didn't know the yield curve inverted, I would still think there's probably a high likelihood of a recession coming up. And you also have to think about like, what if, like, how predictive is this really? Because let's look here, for example. Here's the yield curve. It inverted in 1998. 1998. The recession was in 2001. What is that, like 3 years? 3 years. Am I even on the right source here? Yeah, 3 years later. And so it's like, how useful is it really? It's like me stubbing my toe, and then 2 months later there's a recession. I'm like, that's weird. And I stub my toe again, and then 2 years later there's a recession. I'm like, dude, check this out. Every time I stub my toe, and I go and I stub my toe again, I start crying like a little baby. And then 3 years later there's a recession. I go, every time I stub my toe, there's a recession. I could correlate it with me drinking coffee. Well, actually not anymore because I don't drink coffee. But you could correlate it to how many times when you get a bogey, like anything could happen. And then at some point, a recession can occur because, anyway, I just kind of wonder how much of it is looking at, stars for meaning and looking at the tea leaves. But, it's not totally that way because it makes sense that people are scared. So they want higher maturity or higher yields or shorter term maturities. I'm just putting a point and saying, how useful is it really if you don't know when the recession is coming? It's not. It just proves the point that you need to have a robust portfolio that can handle recessions. Otherwise, you're going to be in for a bad time eventually anyway. So even if you're blind to this, you should have a robust portfolio that's well balanced between a large group of stocks, and maybe have bond funds and stuff. You can have dividend paying stocks. I only hate those mostly when they're outside of a tax deferred account. I actually am putting money in my Roth IRA into a bond funds, B&D particularly, because that's mostly treasuries and not corporate, although it does have some corporate, because it won't be correlated with a downturn. Because during the Great Recession, you have a huge downturn and all companies perform poorly, grossly across the board, and they're going to start defaulting on their debt. And so therefore, corporate bonds that are being defaulted are going to be correlated with a downturn in equities. So you want to be more leaning toward treasuries than you do corporate bonds when you anticipate something like a recession. So it has to be robust in your trading strategy, if it exists at all. People talk about their trading strategies and they say, why don't you try this golden rule, blah, blah, blah. And I ask, how long have you been doing it? And they say like a month and a half every time. Most people who've been trading for a long period of time are sad. And that's just the fact of the matter. The majority are. They're sad people. And I wouldn't trade seats with them for anything. I talk about options because I like leap options, and I'm waiting to strike eventually. I just don't feel like right now is the right point in time. I've talked about that in a different video. Yeah, and I Googled when was COVID first discovered because I was curious if that was like right when the yield curve inverted, but actually it was discovered in December of 2019, which is wait, am I high? Yeah. So wait, hold up 1 second. Let's flip over to the screen really quick. When was COVID first discovered? It was discovered in December 2019. Before then, the economy and everything, everybody was like, things are going great. The economy's going great. Nothing's wrong with the economy. Everything's fine. December 2019. So let's go to December 2019 really quick, shall we? Put our tinfoil hats on. There it is, December 2019. The flash in the yield curve, I remember I was in college when it happened. The flash in the yield curve happened before that. So why did it happen before that if we didn't know about coronavirus until December of 19? And really, did it flash negative? It was 0, and then we had a recession. So was that actually predictive or not? So you can see it carries some flaws. And the most important thing, again, and I'll say it one last time, is to have a robust portfolio. And if you don't know how to build a robust portfolio, let me help you. It would contain 2 funds. It would be VU and QQQM. Both contain very low expense ratios. And then if you wanted to, you could do VTI, which is a total bond or total stock market index. That's a 3-fund portfolio that will grow over time. And then it may not grow very aggressively, but then you can work on things in your life that maximize income and maximize who you are as a person, which is much more important than the money you make, but it would still grow and you wouldn't have to worry about it. There's a saying, VTI and chill, for a reason, and it's because it's so easy. It doesn't have like crazy returns, but it's an easy way to invest. Now, for me, I do a mix. I do, some VU, I do some QQQM, and I do a lot of individual stocks, and then doing a bond fund right now, BND, like I said, so that I can stack up some dry powder, kind of moist powder, while getting some coupons paid out to me. And then when I feel the time is right, I will take some money and I will buy some leaps. But I don't think the time is right now, and I've talked about that before. I think I covered everything I wanted to say. This is like the third take because my microphone went out both times. So thanks so much for watching. This is In the Money. I encourage you to subscribe, and love each and every single one of you in a special and unique way. Here comes the outro music. I won't forget this time. 1, 2, 3, bam.